I think there were a lot of risks, and there still are risks that we discuss on a daily basis, whether it's trade wars, the risk of impending slowdown in China or political instability in Europe. And those still all exist. But I think investors have maybe strayed away from what we always encourage everyone to look at, which is the fundamentals, right? S&P 500 companies giving us 23% earnings per share growth in the recent earnings season. European companies giving us similarly high, maybe not as high, but quite high for European trend numbers, and companies are doing well. Revenues are strong across the world, and yes, there are risks, but at the end of the day, global growth is still positive, and you've got the U.S. booming ahead, really helping the entire global growth picture look quite strong. And perhaps outflows, though they have been negative in some parts of the world, at a certain valuation, investors do come back in, and perhaps we're seeing a bit of that this week.
Is there anything to the idea that the market structure has changed so much that we're just not going to get the moves that we used to have over history, that the way people invest through ETFs or passively, whatever you want to call it, is altering the way this market reacts?
I certainly think the reaction function of markets is going to be different now as there's increased levels of products, whether it's passive or even technological solutions that investors may use. So certainly things may be smoothed, but they can also be equally exacerbated if there are dramatic market sell-offs or dramatic upticks, right, in index rebalancing for some of the ETF type products. So I wouldn't use that as specifically a potential risk or even mitigated of risks as an investor. I think you still got to look at the fundamentals, what companies are delivering you earnings, and what regions have that outperformance capability on a global basis.
We talk a lot. When things are good, we want to talk about the risk. When things are bad, we want to talk about the upside, because you want to go the opposite. That's kind of where the discussion lies. Things are obviously good now. We've talked a lot about risks, but what's the risk to the upside, Nandini? What I mean by that is, what is the best case scenario? Everyone's waiting for this rally to stall. What would be the thing that could keep this market rally going globally? What's the best case scenario?
Well, I think on a sort of theoretical framework, before I get to the good stuff, I'll just mention the key risk and then talk about why that might be extended or mitigated. The key risk is that the business cycle ends in the U.S. That causes a slowdown in growth, and then that kind of drags down the rest of the world, and we're kind of at a natural end of the cycle, which brings the markets down along with it. Now, the reason that could be pushed much further along is if we see a resurgence in productivity, right? The real reason companies would struggle in the U.S. is because higher interest rates, higher wages that they have to pay out, but companies can handle higher wages if they're getting more productive output out of their workers. And if we see an increase in that, which we actually are starting to see a small bit of productivity coming back in the U.S., on an economic basis, there's no actual need for a recession or a slowdown to happen if we still have positive economic momentum in productivity and in output from U.S. companies, which then can allow the global cycle to continue much further. So really the view that, in 2 years' time, a slowdown is due could totally be blown out of the water if we see increased output from U.S. and global companies.